Hey everyone, Zachary Jensen here, managing partner at TaxWise Financial Services, where we are empowering first-time business buyers to maximize tax savings and grow with confidence. Today, I'm going to be going over one of the most important topics when it comes to buying a business, which is, do I do an asset purchase or do I do a stock purchase? Each comes with its own share of liability, so I'm going to be diving into each. I even made a little presentation for you here. So with that, let's get started. Let me share my screen and we'll go deep into it. Let me get that fully sharing. Okay, and now you guys can see that and I can see me. Let me get my prompt up here. Awesome. All right, so today we're going to be talking about the asset purchase versus stock purchase, right? Asset purchases, what are these? This is when the buyer actually acquires specific assets in a business, like inventory, goodwill, equipment, or a stock purchase when you're actually buying the entity itself. So you can think of it if I created a new LLC and I wanted to do an asset purchase, well, all of the assets from the business I'm buying will then go into my new LLC. Whereas if I have a stock purchase, buyers actually will buy the entire entity itself, usually a C Corp of some kind. So the key differences here, asset purchases are stepping up in basis from a tax perspective. So you get more depreciation. And stock purchases, there's actually no step up. You inherit the liabilities and the assets because remember, we're buying that entity and usually it is a C Corp, which comes along with its own individual basis and assets. So just right off the bat, asset purchases are going to have a huge win for folks that are interested in taking advantage of higher tax savings earlier on, because we're going to be able to have that step up in depreciation or step up in tax basis and have more depreciation, which we'll get into in a second. So tax benefits of asset purchases, right? Step up in basis allows for higher depreciation and amortization deductions. So when I buy that business and I have it, essentially the assets of that business go into my new LLC, well, those are new to me. The basis of those is as high as it's ever going to be. And then I can depreciate those assets now over 5 to 7 years, taking advantage of nice tax savings or expense a lot of them immediately. The main thing that you're going to inherit or not inherit, purchase when you open up a new business is the intangible assets of goodwill. That is usually the majority of the asset purchase, and that is amortized over 15 years. So you could take an example here. If I made a purchase of $5 million, I bought a $2 million machinery. We took advantage of some bonus depreciation, offset a large tax liability in year one, got some inventory as well, and then also had some goodwill, which gets amortized over that 15 years we have there. And yes, the numbers don't add up. I know that. Tax treatment of stock purchases. So there's no step up in basis, right? The buyer, you inherits the original seller's basis, and there's limited deductions for depreciated assets. So if you had a seller's basis that was really, really low, but you had that purchase price, no new depreciation or amortization comes up. Liability risks in stock purchases. This is another huge downside of stock purchases, right? Where the buyer assumes all existing liability of that entity. So if that entity has any unpaid taxes or any payroll obligations or pending lawsuits, you as the buyer are going to have to inherit that. So you have to really conduct thorough due diligence and negotiate any sort of indemnity, I can never say that properly, provisions or price adjustments to account for that risk. So seller preferences and negotiations, right? Sellers often prefer stock sales for capital gains treatments, right? You are going to be getting that 20% treatment. In some cases, it can go up to 37% in asset sales. Usually doesn't though, because it's a asset of your own, but just clarifying here that sometimes that can happen. But the buyer is usually wanting the asset purchase for the reasons we mentioned earlier. And here are special situations favoring stock purchases. So, you might need to retain a valuable license or contract, right? Now, Zach, why would I do the stock purchase? Well, if you had to get, let's say, a special license that was issued to that company to conduct business, and doing so for your new entity with the new assets, right? Because it's a new entity, you're just putting the assets in the new entity. Doing so, getting that license is going to be a pain. you might not want to do the asset purchase. A stock purchase might make sense. So, and that leads us a bit to the section 338H election, which allows stock purchases to be treated as asset purchases for tax purposes. We dive into this. It's very situational with clients, but I just thought I'd mention it, right? So it allows for kind of all the benefits we talked about, but requires an agreement between the buyer and seller, and it's not available for C corporations when this usually applies. So in reality, this is not done usually. So just want to share some key takeaways here. Asset purchases, they're more tax efficient, more deductions, fewer liabilities for the buyer. Stock purchases are simpler, right, but riskier, and they also limit the deductions for the buyer. So if you're thinking about, hey, should I do an asset purchase? Should I do a stock purchase? There's some complexity. Definitely reach out to an accountant that can help you and help you understand all of the nuances involved. So that's a bit about asset purchases and stock purchases. If you have any questions, feel free to reach out to me on the social medias. I have my links below in the description that you can always reach me at. And yeah, I'm looking forward to speaking with you then. Thank you so much for watching. Bye-bye.